If you are seriously considering moving to the Canary Islands for tax reasons, there is one mistake that can destroy the entire strategy before you even arrive. And the surprising part is that this mistake does not happen in Spain, it happens in your home country. We see it constantly, entrepreneurs who plan the entry perfectly but completely ignore the exit. And in international taxation, the exit is often more important than the arrival. Before talking about the Canary Island, the 4% regime or any tax advantage, you must answer one fundamental question. What exactly are you leaving behind? Is your business closing or staying open? If it stays open, are you still the economic engine behind it? Because physically relocating is one thing, but ceasing to be the center of economic interest is another. If you continue generating revenue from the same clients, through the same structure, with the same operational control, simply changing your address may not change your tax residency at all. Many people assume that once they leave their country and spend fewer than 183 days there, the problem is solved. But tax residency in most European countries is not determined only by counting days. It also depends on where your main economic interests are located, where your companies operate, where your family live, where your primary assets are managed, and where strategic decisions are made. And if these elements remain concentrated in your home country, tax authorities may continue to consider you resident there regardless of where you physically live. We often encounter self-employed professionals who believe that because they stop invoicing locally, their obligation disappear. They left dormant companies behind with open bank accounts, retained earnings, pending dividends, related party transactions, or unresolved compliance issues. Dormant does not mean invisible. Dormant entities still create legal and tax exposure, and in many cases problems appear years later, when audits begin or when large taxation appears. Another critical factor is personalities. Owning a home, maintaining family residency, keeping children in school, managing investment activity from the original country, all of these elements contribute to the analysis of tax residencies, and when a tax authority challenges your position, proving that your move was genuine becomes significantly more complex. International taxation rarely depends on one single decisive factor. It depends on a coherent set of evidence. This is why we insist on something that may sound simple, but is rarely done properly. Before moving, you need a clear financial and legal picture of your departure. You need to know what you are closing, what you are restructuring, what you are keeping, and under what conditions. You need to review corporate governance, dividend policy, management roles, banking relationships, and contractual obligations. Because when you arrive in the Canary Islands, it is often too late to correct structural mistakes at the exit stage. There is also a psychological aspect. Many relocation decisions are driven by attractive percentage seen online, comparisons between countries, or simplicity videos promising efficiency. But taxation is not a marketing exercise. It's a structural decision that affects your stability, your operations, and your long-term security. Moving quickly may feel decisive, but in cross-border taxation, speed often increases risk. So, before asking whether the Canary Islands are the right jurisdiction for you, ask yourself whether you have properly disengaged from your current ones. Have you formally modified your role in your companies? Have you assessed whether exit taxes apply? Have you analyzed how ongoing income will be classified once you move? Have you documented the change in management and decision-making location? These are not minor technicalities. They are the foundation of a defendable tax position. The Canary Islands can offer significant advantage if you structure correctly, but those advantages only work if your previous country recognizes that you genuinely left. And recognition does not come from intention. It comes from documentation, structure, and consistency. The most common and costly mistake is not filing in Spain. It is failing to close the chapter before arriving. In international taxation, what is done correctly at the beginning rarely creates problems later. But what is done poorly at the exit stage can follow you for years. In the next video, we will explain how tax residency is actually determined in Europe and why counting days is only part of the equation.